Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Daily Market Commentary and Analysis. This video presents a direct informational narration of the source document. All right, let's dive right in. The source document notes that on July 31st, there was a broad Asian market rally driven directly by AI trading. Right alongside this, the Bank of Japan maintained its target rate exactly at 1%. Looking at specific companies, the document details Kioxia Holdings' earnings report. They posted a net profit of 45 billion JPY and announced a stock buyback along with a 1-for-3 stock split. Because of these moves, the stock price surged by a massive 17%. That momentum really carried over into the broader market. The KSPI index saw a massive 17.9% rebound. To give you some context on the scale here, the source points out this was driven by a record 7.2 trillion won in daily foreign inflows. And the single-day gains were truly record-breaking. According to the document, SK Hynix shot up by 30%, and Samsung Electronics was right behind it, up 27%. Just absolute record-shattering numbers for a single day. But then, we see a dramatic shift in the timeline. The report explains an initial high open in the U.S. markets, which was abruptly followed by a sudden flash crash. This was triggered by a Reuters report about potential U.S. intervention in the yen market, which caused the yen to surge and led directly to a tech sell-off. The drop was incredibly sharp. Over just a 40-minute window, the S&P 500 went from being up 0.7% to down 0.45%, hitting a maximum intraday drop of 1.2%. The document calculates that this evaporated $920 billion in market value, entirely wiping it out. So what were the exact mechanics of this unwinding? First, the New York Fed notified banks. This caused the yen to surge, which forced traders into rapidly unwinding their carry trades. To cover those suddenly expensive positions, U.S. tech and Treasury assets were quickly sold off. The document explains that expectations of Japan selling U.S. Treasuries pushed yields straight up. Specifically, the U.S. 10-year Treasury yield spiked near 4.75%. This put serious pressure on AI stocks, like Micron, which dropped 6% right from its opening high. We did see a technical rebound, though. The S&P 500 dropped from 5512 down to the 5500 weekly resistance level, but then rebounded past the mid-month downtrend line. Because it hit such oversold levels, JP Morgan even issued a short-term tactical buy signal. However, the source has a clear warning here. Those U.S. Treasury intervention preparations indicate ongoing mid to long-term risks for carry trade unwinds. That means August risk remains highly elevated for subsequent waves of concentrated selling. Looking at the technical setup, the Nasdaq tested its triangle support. It managed to gain 1.59% for the week, sitting right above the 20-week moving average, but staying below the 5-week moving average. The report notes it held its 5-day moving average, which is described as hesitant movement typical of early-stage bullish behavior. Now, the source makes a direct comparison between indices here, heavily criticizing the Nasdaq for quickly adding SpaceX into the QQQ. That move essentially brings higher long-term volatility and risk. On the other hand, the S&P Dow Jones Index maintains strict inclusion rules, making funds like VOO the option with lower volatility and better discipline. Moving over to semiconductors, the SOXX index had a 5% intraday climb. The document highlights the persistent volatility stemming from those intervention risks and the ongoing long versus short institutional battle. Right now, it's targeting the 50-day moving average, with the 5-day moving average serving as the critical support line. Institutional views are actually completely divided on the DRAM sector, which fell 3.76%. Morgan Stanley and TrendForce hold a bearish view, pointing out that spot price growth is slowing. Conversely, Goldman Sachs and Citi are aggressively bullish. They argue that 3- to 5-year contracts are increasing, which protects earnings and reduces volatility. Because the memory sector faces such high, extreme volatility right now, the source document shares a specific view on capital management. It suggests avoiding concentrating capital in memory stocks. Instead, it advises that capital should consider rotating into broad indices like VOO or QQQ for much-needed stability. Let's switch gears over to Amazon, which saw a massive 15.3% stock surge. The report attributes this jump to Amazon's management finally clarifying the return on investment specifically for their AI capital expenditures. Breaking down that management explanation, Amazon's AI payback period is under 3 years, but their server lifespan is 5 to 6 years. Even more significantly, their data center lifespan is over 30 years. This means those 30-year data centers lower the marginal costs for future hardware iterations, all while their AI computing demand is securely locked in for over 5 years. The source notes that this commercial closed-loop logic completely validated their capital expenditures. Because big tech AI CapEx is backed by locked contracts and clear returns, it rescued both Amazon and Google stocks by confirming that semiconductor demand is structural, which really helped ease market fears of an AI bubble. On the funding side, the document states the U.S. government provided $870 million in federal funding to 7 chip companies. That total includes up to $300 million dedicated specifically to next-generation photonics. Going back to earnings, the source details a remarkably strong Q2 for Reddit. Revenue hit $805 million, which is up 61% year over year, and profit came in at $253 million, up 183%. But the stock actually dropped 21%. This was caused by the CEO's warning about weak Q3 guidance, specifically noting that Google's AI overviews are actively reducing their direct search traffic. The document also reports on Coinbase. Their Q2 revenue was $1.22 billion, which missed the $1.29 billion estimate. They recorded a net loss of $59 million, making it their second consecutive quarterly loss, and the stock fell 10%. From a technical perspective, the report explicitly recommends a stop loss precisely at $140. Over in the broader crypto market, the source points out that MicroStrategy recorded a staggering $8.2 billion impairment charge. This was applied to their $58 billion Bitcoin holdings, entirely due to falling prices in a prolonged slump. But interestingly, despite that massive hit, MicroStrategy's stock only fell 4.5%. The source document concludes its analysis of these market conditions by indicating a clear preference for the AI hardware sector over the crypto sector.